The U.S. national debt is nearing $36 trillion and is expected to continue to rise even as a percentage of GDP. What does this mean for our economy? Well, our next guest warns that an out of control debt level could be the catalyst for another financial crisis, and she's going to explain how. She is Sheila Bair, former chair of the Federal Deposit Insurance Corporation, the FDIC, from 2006 to 2011, where she played a pivotal role during the 2008 financial crisis. She is also the former board chair of Fannie Mae, and she's currently an author of several books, including a series of children's books which teaches kids financial literacy called Money Tales. We'll be talking about her outlook on inflation, the future of the economy, and monetary policy under a Trump administration. An honor to host you, Sheila. Welcome to the show. Thank you for joining us.
Well, thank you, David.
The issue of inflation is something that may or may not be in the rearview mirror. We'll talk about that. It's not often I open the show with a children's book, but it is a very good book with very important themes that resonate with a lot of Americans, I think, and not just children, but also adults. So Princess Persephone and the Money Wizards. Inflation comes to Ganymede. It follows the story of a young princess who, I'll let you explain the story. But anyway, how does inflation come into this fictitious land in which she resides?
So it's a inflation, like a lot of things, is a simple function of supply and demand imbalances. So in this story, she wants to go on some expensive vacations, but the palace only has a budget for her to go, and she wants her friends to go, and they don't have the money. So she tells her money wizards, who are her central bankers, to just print more money and give it to everybody so her friends can go on vacation with her. And of course, when they do that, the price of everything just goes up because they're flooding the economy with money, but the capacity of the economy to produce more goods and services to meet the increased demand from all that money you can't do it immediately. So she learns. So she's frustrated that prices just keep going up, and her friends still can't afford to go on vacation with her. And then people start getting mad, and then her dad comes home. Fortunately, who's been out. The king has been out on the asteroid field somewhere doing some kind of business. He comes back tells the money wizards to stop the printing presses, and then he opens up a savings plan. So he tells people if they save money, he's going to give them a nice interest rate if they'll put their money into a savings account, and that drains a lot of the cash out of the economy, and things get back to normal. So it's and there's all my books have nonfiction educational matter in the back that explain the basics around inflation, the basic drivers, and historically, the experience we've had with inflation. And but I think it's an important lesson for kids. Most of my books are more personal finance oriented, trying to help avoid overborrowing, save regularly, that type of thing. This is really more of an economics book. But I do think as future taxpaying citizens and future voters, or maybe future government leaders, they need to understand the basics of inflation, because if we've seen with the results of this most recent election, people do not like inflation. Inflation causes a lot of harm and damage, and it's across the economy. So it's important to understand its risks.
Yeah, there's a lot of humor in this book, but a lot of seriousness as well. The princess stopped them. Just do as I say. The money has uses. How much do you want? The wizard then asked. Whatever there's now, she said, double it fast. $1 trillion has been created. 1 trillion more, as the princess dictated, would double the cash in circulation. Does the government currently, in the U.S. at least, I'm talking about the congressional side, does anybody in the White House have the ability or the power, as the princess does now, which is to dictate the bank or Federal Reserve in this case to create money?
No, I mean that's a function of the central bank, and its legal structure is designed to keep it independent and free from political influence, which is important because sometimes easy money can be popular with a lot of people. Yeah, let's lower those borrowing costs, right? A lot of companies like to be able to borrow cheaply. A lot of hedge funds, private equity funds. There's a lot of people in this country who love low interest rates because their whole business is based on borrowing. And the lower the better. And they have a lot of political influence too. So you don't want politicians in control of this. This is something the Fed should do. Now, they're not perfect. I've criticized them in the past, but I don't think for a nanosecond that they've ever been politically influenced. I think they're trying to do what they can, and it's hard. It's hard to gauge what the right level of money supply and interest rates should be. And they're struggling with it now. I think inflation has not been beat back. It worries me because they had a huge 50 basis point cut, then another 25, and they look like they're going another 25,
Yeah.
and maybe doing another 100 next year. And housing inflation in particular is still quite high. So I think that's ill-advised.
Well, this is one of the questions asked to Jerome Powell at the last FOMC press conference. Take a look at this question and how he responded, please. Just like to get your response to this.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume.
So a non-answer to her question about what they would do. I mean, what do you think they will likely do in response to Trump's fiscal policies?
Yeah. Well, I don't know. I think, Alan Greenspan used to talk about the budget deficit and challenge Congress on it, because budget deficits at certain levels do become quite inflationary. And Jerome Powell has taken a different approach. He's decided to stay out of that. He's afraid that if he's opined on that, it looks like he's getting political. So that's been his decision. So that's my first observation. This response, this kind of non-response, is consistent with how he's handled things in past administrations. So, but clearly, I mean, both Trump and Harris had highly inflationary policies, big deficits. Mr. Trump was much bigger than Ms. Harris's, but it is going to be a factor, and they will have to watch and see. But it may dictate further tightening if this. And it's not just the deficits; it's tariffs, what could increase the cost of imported goods. That could also play in. So I hope it works out. I really do. He's our president. I didn't vote for him, but I want him to succeed, and I want the economy to do well and keep doing well. But they're going to have to watch this carefully, because a lot of what he's contemplating doing, it's hard to imagine that it will not be inflationary.
Sorry, Sheila, did you say tightening from the Fed? That's a possibility?
I would say, well, we'll depend. We'll see what happens next year.
Yeah.
I've been saying that they should stand pat for a long time. It's a common misperception that low interest rates help the economy, right? That's the underlying assumption around all of this, that somehow low interest rates help the real economy. And the empirical research just isn't there. Actually, you've seen more robust growth when interest rates have been more at more normal levels. And we had ultra low rates after the great financial crisis for, head on 14 years. It really didn't do much. Main Street was in a 10-year recession after the great financial crisis. Those low rates helped the financial sector. They didn't help Main Street. And the problem with low rates is they weigh on productivity, because when money is cheap, people are sloppy about how they allocate it. That's why you get asset bubbles. You get a lot of leverage. So you get instability, you get asset bubbles, you get zombie companies, because, if the cost of money are near zero or maybe even negative, real rates being even negative, investors are sloppy about how they allocate it. Higher rates create more disciplined capital allocation, which improves productivity. It also constrains some of the consolidation we've been seeing, corporate consolidation we've been seeing over the past several years, because, again, low rates particularly help the larger companies that can access the bond market. So if you're a smaller business relying on bank lending, there's less of a flow-through effect, but the larger companies are able to, with their huge footprint and balance sheets, are able to really exploit low rates. And this has fed a lot of consolidation. because all this cheap money running around. Hey, let's go buy some stuff, right? So, and then that creates that lessens competition and innovation for the smaller companies. So, there is significant research on this, and it's frustrating to me that it doesn't get traction because the assumption still is, low rates are good for the economy, good for the labor market. High rates are bad. That's just not true. It's just not true.
I'd like to point to this article that you wrote for Barron's dated at the end of October. U.S. debt could drive the next financial crisis. In this paragraph in particular, make no mistake, if we continue on this path, investors will eventually lose confidence in our debt. The change could be gradual or sudden, but the consequences will be painful no matter the pace. The federal government's interest costs already at almost $900 billion for 2024 will increase dramatically as investors demand a higher risk premium. So walk us through the process, Sheila, from rising debt to a potential painful financial crisis. What is the transmission mechanism here?
Right. Well, if investors start losing confidence in our debt, they will either stop buying our debt, which will create a problem because our government is so heavily reliant on deficit financing to operate.
Yes.
Or more likely, they will require a very steep risk premium. So that means they will take rates really high. Now, I've said higher rates, more normalized rates are good for the economy. Super high rates are not. And if the federal government's borrowing costs spike up, they're going to be spending even more money on interest, crowding out spending in other areas of the federal budget. Private borrowing costs are also tagged, most of them, one way or another, to government borrowing costs. So as government borrowing costs go up, private borrowing costs are going to go up as well. And then importantly, for financial system instability, banks, insurance companies, pension funds, managed funds hold massive amounts of Treasury securities. Mm-hmm. If the yields on newly issued Treasury securities start going up, the value of the ones that they're currently holding will go down dramatically, creating widespread market losses on these holdings. And this is, if you remember the bank failures of a few years ago, the regional bank failures, that is exactly what was going on. Silicon Valley Bank had loaded up on some very low interest yielding government securities right before the Fed started raising rates. And the market losses on those securities are what led to its failure. So this is serious stuff, right? This is not, people kind of, people talking about the deficit again. We've been fortunate because we are the world's reserve currency, as my friend Alan Simpson used to say, we're the best looking horse in the glue factory.
Yeah.
So people continue to buy U.S. debt as a safe place to keep their money. That's going to keep happening until it doesn't. And so we cannot assume that will be continuing. And that article also cited a CFA Institute survey. The CFA chartered analysts, these are thousands of the gold people who have met the gold standard in terms of investor analyst expertise. They're saying in the next 5 or 10 years we'll probably lose a reserve currency status. Could be gradual, could be fast. And that they don't have any confidence in the political will in Washington to do anything about this. So I think, ironically, now we're seeing this become an issue finally, because this has been going on for a long time. Obama, Biden, just go back since Reagan. These deficits have been going up and up and up. And that's another point I make in this op-ed, that every time we have a crisis,
right,
whether it was 9/11 when I was at Treasury or the Great Financial Crisis or the pandemic, we ratchet up those deficits. We borrow a lot to spend a lot to help the economy, but then we don't stop. We just keep going. And that's what's happened. And that's why, we have our national debt levels, our nosebleed levels, and unprecedented levels as a percentage of GDP. And it's going to get worse before it gets better.
So, you wrote here, super majority of the 70% of the CFA analysts surveyed in this study believe the U.S. finances were on an unsustainable trajectory. So, Sheila, if you were one of the wizards in Ganymede, right, hypothetically, you could wave your wand and fix everything you wanted with the wave of your wand. What would you do to solve this rising debt problem?
Yeah. Well, I would keep interest rates. There was a very simplified monetary model in my book, but I would keep interest rates, the supply of credit, the supply of money, I wouldn't loosen that. I would keep it about where it is. And I would
don't you think,
engage.
sorry, just to push back on that,
Yeah.
don't you think that a lower interest rate is needed to boost the confidence? If people are losing confidence in debt, wouldn't you need a lower cost of capital to boost that
Well,
confidence?
you're assuming that the central bank can control this. I'm talking about what the market's going to want
I
for
see.
interest rates, and it doesn't matter what the Fed does. The Fed can try to take it back to zero. If global investors are saying the U.S. is a risky bet, we want 10-15% on your treasury bonds, I don't think that's going to happen. That's an extreme example to make a point. But that's the problem. The market will drive this. The central bank won't drive it. So yeah, I think it's not so much bringing the nominal dollar amount down. It's a matter of bringing the debt down as a percentage of GDP. It's the publicly held debt is right at 100% of GDP, which is really a pretty high level. Gross debt's about 24% now. I think it keeps going up. You got to check the debt clock every day to see where it is. But so it's high. It's too high. And if we can get it down to more sustainable level, a more sustainable trajectory, I think that would give investors confidence. A related problem is Social Security and Medicare. Those trust funds, Social Security trust fund is going to be short of money in just 9 years. And then the trust funds will run dry. So the only money supporting Social Security will be the money coming in that workers are paying. And that's only going to, I think, cover about 75% of the benefits. So that needs to be dealt with now. I wrote another book called Rock and the Savings Shock about the power of compounding interest. But I wish Congress would realize if they start accumulating savings now in Social Security, they can experience from 9 years of accumulation and compound growth. So then when we hit that, in 10 years, the whole, it shrinks and shrinks and shrinks. So waiting until the last minute to not be able to benefit from that 9 years of compound growth, accumulation and growth, it's just crazy. Frankly, we knew this was going to be a problem back in the Clinton era. And people were saying then, let's just make some tweaks now, because over a period of years, very small tweaks will solve this problem. Nobody wanted to do it. Nobody wants to touch Social Security. So that really is a conversation that has to occur in Congress, and it has to be bipartisan, because Social Security is such a hot potato when it comes to people. They rely on it for their retirees rely on it.
Good segue. I think the current administration wants to address some of these government efficiencies. They've started this new commission, D.O.G.E, Department of Government Efficiency. It's going to be headed by Vivek Ramaswamy, former Republican nominee, and also Elon Musk. Let's just take a listen to what Vivek said. It's about 30 seconds. He said this on the Tucker Carlson show. Take a listen, please.
These two things go together, though. Because if you actually did take one of those agencies and say, hey, you have to show up to work 5 days a week, and actually you have to go to Topeka, Kansas or Cincinnati, Ohio instead, you'd actually have a good number of the people quit anyway, which avoids the severance costs. So I kind of like that method, as you could kind of get 2 in 1 right there, is thinning it down and moving it out. But yeah, move the agencies out. You should fire about 75% of the federal employee headcount. If not, immediately on day one, you could ease into that pretty quickly. Agencies that are redundant can be reorganized that shouldn't exist. Department of Education is a good example. Shut it down, send the money back. Workforce training can move to the Department of Labor, and loan collections can move to Treasury. There's just a mass opportunity for a mega reorganization and thereby downsizing of this bureaucracy. And it's a one-way ratchet, because it's not like if another president comes back, they can write that back into existence by fiat. They'd actually have to go through Congress to do it.
He wants to reduce headcount by 75%, eliminate redundant agencies. He cited the Department of Education as one. What do you think? What's your response here?
Well, I think there's probably some trimming that can be done with the federal workforce. And certainly in the Department of Education, I think that they need to do a serious reassessment of what's going on with student debt cancellation. That really has nothing to do with headcount. Even if you assumed he's right, the 75% of federal employees are unnecessary, and I do not think that's right. I'm not sure what the savings would be. I would encourage them. Fine. You want to, trim federal employee headcount a bit. You can try to do that. Again, don't impair the functioning of government. Those people help people. My old agency, the FDIC, they protect insured depositors when their banks fail. That's kind of an important function. I don't think when I took that agency over, it had been cut back to bare bones, and we had to do some rebuilding pretty quickly. So be careful about that. If you want to look for some savings, look at some of the rent seeking that's going on in these government programs. healthcare, Medicare fraud. There's been a lot written about that. Student loan, this whole program, the student loan program, the debt cancellation is rewarding primarily graduate and professional students have run up large amounts of debt. And ultimately, that program, because it's been so unlimited in the amount of money that the federal government's willing to lend to graduate and professional students, it's really benefited colleges and universities that have had no skin in the game in this. So stopping that, putting some sensible caps on student loans, especially for graduate and professional students, rolling back all of this confusing debt cancellation, most of which is unconstitutional anyway, you could save some real money there. And the Department of Defense, boy, I support strong defense. I think we're in perilous times and we need to have a strong defense budget. But that place hasn't been audited for decades. And you can't tell me, and you can't tell me that the defense contractors and others, there's not a lot of fat and rent seeking going on there. So look at the external people who make money off of the government. There's a lot of rent seeking there, and boy, I tell you, that's where I would prioritize. Not so much federal employees. I know they're a popular whipping boy, and I'm not saying there isn't some bloat. There is, but most federal employees I know, and I was one for many years, they work hard. They're dedicated public service. They're there because they want to help people, and you need them to run an effective administration. Don't be demonizing all of them and saying, "Oh, we don't need you anymore," without thoughtfully taking a look and having some analysis around that. And I think if you do some thoughtful analysis, you will find that most of those folks we need.
Yeah. All right. Finally, I want to touch on the health of the current banking sector. Let's turn to the FDIC quarterly here. This is from Q2. And I just want to point to chart 7 in particular here. Unrealized gains and losses on investment securities. This has been ballooning ever since 2021. And the unrealized losses on the books of the banks held to maturity and available for sale securities now greatly exceed that of 2008. What does this mean?
Yeah, so I think there's first of all, if they hold this to maturity, they will not have to book losses. The problem is sometimes for liquidity to raise cash, you need to sell your securities and you have to realize losses. So that's why these numbers are important, even though they're unreal. These are unrealized losses. I think the regulators since Silicon Valley, since we've had that series of regional bank failures, the examiners in particular have been all over this. Some of those holdings have been whittled down. Reserves against them have been increased, better reporting. So I'm actually feeling pretty good right now about the banking sector, including the regional banks. I do think there is an issue with their liquidity if there is more financial stress, primarily because we have something called too big to fail, which is a doctrine I oppose, but unfortunately we do. And it's the public perception that the biggest banks like JP Morgan Chase and B of A are too big to fail. And so the government will never let them fail. So in times of stress, when people start worrying about banks, what happens? Deposits starts flowing out of those smaller banks into these bigger ones. And it's if it's a particular problem for something called transaction accounts, which are basically the accounts that businesses have with banks to make payments, to receive and make payments. And so those are almost always insured deposit limits just by their nature. There's a lot of money going in and out of them. So I do think we need much higher deposit limit, insured deposit limit levels for that category of transaction accounts. This would help the regional banks and community banks a lot, because if we get into stress again, I hope we don't. I think things are pretty solid right now, but you're going to see this flight of deposits to these big banks again. It's going to stress the smaller ones and make the big ones even bigger.
What does chart 8 mean? The number of assets of banks on the problem bank list. What is the problem bank list?
The problem bank list, yeah. So the problem bank list, you can see it's. I have to.
Yeah, I'll zoom in here.
Sorry. Yeah. There we go. The picture of you is kind of well, I think I know what it is, where it is right now. Problem bank list is when banks basically that have very low very weak supervisory ratings. So banks that have deposit insurance have examiners that go in there periodically and they grade them on their health. And basically the problem banks are saying that their examiners are saying that these banks have serious problems and are at risk of failure. That doesn't mean they will fail. Most of them don't, because once you get on that problem bank list, you get a lot of intensive attention from both the regulators as well as oversight boards and others. So usually banks being on that list is a powerful incentive to get yourself cleaned up.
Mhm.
And again, examiners give them a lot of attention. And that's, that's still the total number of banks that we have. I think we've got about 4,500 or so now. That's not very many. That's a very small percentage of banks that are even troubled or a problem. And I will say to, Main Street households listening to this, if you're below the insured deposit limits, do not worry about it. Just don't. It's 250,000. You can get a lot more of that actually. If a joint account, you get another 250 with your spouse. The FDIC website has lots of ways you can determine how much deposit insurance you can get at an individual bank. But if you're below those limits, don't worry. The FDIC's always protected people. It's had a perfect record. There's never been a penny of insured deposits that have been lost when a bank fails. So it's really, for Main Street households, and the vast majority of people are below the $250,000 limit. This chart, it's good to be aware of, but it's not something that they personally need to worry about.
Last question, Sheila. So the current administration is a little bit more, I would say, friendly to the idea of adopting cryptocurrencies. Trump has said on the campaign trail he wants to implement some sort of Bitcoin strategic reserve. I asked this to another FDIC chair, Thomas Honig. The same question I'll ask you again, Sheila. If you were FDIC chair again, would you insure crypto banks?
No, and I don't think they want that. That's really not, FDIC insurance is there. Banks have, fractional reserve banking is inherently unstable because you're taking deposits that are short-term by nature. People can get their deposits back on demand, and you're making long-term loans. So but people need to know that their ready cash is safe, right? That's where people keep their money, that they need to pay bills, the kid's dentist appointment, whatever, the rent. That's where they keep their money. They need to know it's safe and protected and stable. And that's what banks do. And that's why we have deposit insurance. That's not what crypto does. Bitcoin is not a good medium of exchange. It's too volatile, right?
Sure.
People need a stable place for their money. If I've got $1 in my bank, I want to make sure a week from now that dollar has the same value. Not Bitcoin that can go, 40, 50, 60% over a very short period of time back and forth. So look, I'm sympathetic to the crypto technology, blockchain technology, distributed ledgers. I think that has tremendous promise to make payments more efficient. And I advise some companies who are in that business model, and I support that. But Bitcoin is highly volatile. It's not a good payment, and I don't think it's probably a good place for taxpayer money to be put in reserve. There are probably, if you want to get a better yield, there are probably other safer, more time and more trusted areas where you could do that. But no, I don't know why he would even want to do that. And that's so volatile. I would not want the nation's finances trusted to Bitcoin. No.
All right. Well, Sheila, I appreciate your time. So the princess in the Kingdom of Ganymede had a happy ending. She learned the laws of supply and demand well. When they don't meet, an invisible hand will lead to something called price inflation. So on that note, where else can we learn about price inflation from you and read your work?
Well, I write a lot on this topic. You can follow me on Twitter, Sheila Bair 2013, if you want to see what I'm writing about. And I actually have a grown-up book called Bull by the Horns. So I'm afraid that was more about the financial crisis than it was about inflation. But I appreciate your focus on this and trying to raise attention to it and help people understand what's going on. And I hope they found this conversation useful.
Well, I appreciate you educating us on this topic. So thank you very much.
Sure.
So I'll put the links down below. Make sure to follow Sheila there. And thank you for watching. Don't forget to like and subscribe. Thank you, Sheila.
Thanks, David. Bye-bye now.